Let's start with the big question everyone keeps asking. Are we in an AI bubble? And when people say that, what do they really mean? Most of the time, they're not saying artificial intelligence is fake. They're saying expectations may be running far ahead of reality, at least in some parts of the market. One reason people worry is the hype. Right now, almost every company suddenly calls itself AI-powered. We've seen this pattern before, during the dot-com era and later with blockchain. Back then, just adding the right buzzword was enough to attract attention and money. Today, AI plays a similar role. The problem is that many AI companies don't actually control much of the technology. They rely on the same models as everyone else and don't have clear advantages that protect them long term. In many cases, the promises sound bigger than what the technology can reliably deliver in real-world use. Another concern is valuation. Some AI-related stocks are priced as if everything will go perfectly, as if adoption will be fast, regulation won't slow things down, and competition won't reduce profits. History shows that when expectations become that high, reality usually disappoints, even if the technology itself is real. And then there's investor behavior. Huge amounts of money are flowing into anything related to AI, partly because not owning AI exposure feels risky. When that happens, capital often flows into weak ideas along with strong ones. That's another classic warning sign. But here's the important part. This doesn't look like a classic bubble where the underlying thing has no real value. AI already works. It's already improving productivity in healthcare, software, logistics, research, and many other fields. Even imperfect AI systems are useful today. And unlike past bubbles, much of the money being spent is going into real infrastructure, data centers, chips, and computing capacity. Those don't disappear if some companies fail. They get reused by others. We've seen this before. The dot-com bubble burst, but the internet didn't vanish. Some companies failed, but others became giants, like Amazon or Google. AI is likely following the same path. There may be a bubble in companies and expectations, but not in the technology itself. And that distinction is what really matters going forward. So let's assume for a moment that parts of the AI market really are in a bubble. If that's the case, history tells us something important. When bubbles unwind, many stocks drop 50% or more. Not because the technology disappears, but because expectations were simply too high. That's why the real question isn't, is there a bubble? It's which companies can survive it. Because in every major bubble, there are always businesses that come out stronger on the other side. I could easily name the obvious ones here: NVIDIA, AMD, Google. They have scale, cash flow, and dominant positions. But what interests me more right now are companies that may not look exciting on the surface, but play a critical role in the AI ecosystem. Companies that might not be perfectly profitable every quarter, but still feel like a relatively safe place to park capital over the next few years. One of those companies is Oracle. Oracle isn't a flashy AI startup. It's an enterprise software and infrastructure company that has spent decades running mission-critical systems for governments, banks, and large corporations. And that matters because as AI scales, someone has to provide the infrastructure, the cloud, the data centers, the reliability. From a numbers perspective, Oracle looks very different from speculative AI names. It generates tens of billions in annual revenue, earns real profits, and trades at a moderate valuation for a large tech company. Its trailing PE ratio is roughly in the mid-30s, with a forward PE closer to the mid-20s. Earnings per share are around $5.50, and the company pays a dividend of about 1%. Oracle does carry a meaningful amount of debt, and recent free cash flow has been pressured due to heavy spending on AI-related infrastructure. But that spending is tied to long-term assets like data centers rather than short-term hype. That's the key distinction. Oracle doesn't need AI to be perfect. It just needs AI workloads to keep growing. Even if many AI startups fail, the demand for compute, storage, and enterprise-grade systems doesn't disappear. It consolidates. And historically, Companies with real customers, recurring revenue, and infrastructure tend to survive bubbles far better than companies built purely on narratives. So if there is an AI bubble, yes, many stocks may fall sharply. But companies like Oracle are less about betting on hype and more about owning the plumbing that everything else depends on. And that's why, instead of asking which AI stock will explode next, I think it's more useful to ask which companies will still matter 5 years from now. That's the lens I'm using when I look at names like Oracle. Now let's talk about the other company I mentioned earlier, CoreWeave. Because if Oracle represents the stable infrastructure side of AI, CoreWeave represents the opposite end of the spectrum. High risk, high reward. So what is CoreWeave? At its core, CoreWeave is a specialized AI cloud infrastructure company. Its entire business is built around providing high-performance GPUs, mainly for training and running large AI models. In simple terms, CoreWeave rents out massive amounts of compute power to AI companies that don't want to build their own data centers. That makes it extremely important, but also extremely risky. Why important? Because right now, AI demand is bottlenecked by compute. GPUs are scarce, expensive, and difficult to deploy at scale. CoreWeave focuses almost entirely on solving that problem. It's not trying to be everything. It's trying to be the fastest, most efficient way to access AI compute. That's why it has attracted major customers and partnerships tied directly to the AI boom. But here's where the risk comes in. Unlike Oracle, CoreWeave is not profitable. Its earnings per share are negative, which means it's losing money today. So the P/E ratio doesn't really apply in the traditional sense. There are no earnings yet to price. Instead, the entire valuation depends on future growth. And to grow that fast, CoreWeave has taken on a large amount of debt, billions of dollars. That debt is being used to buy GPUs, build infrastructure, and scale as quickly as possible. This is where the bet becomes very clear. If AI demand continues to explode and customers keep signing long-term contracts, that debt can make CoreWeave extremely powerful. It allows them to scale faster than competitors and lock in market share. But if demand slows, pricing drops, or competition increases, that same debt becomes dangerous. Cash flow has also been under pressure because building AI infrastructure is expensive. CoreWeave is spending heavily today in the hope that strong revenue shows up tomorrow. So this is not a sleep well at night stock. This is a leveraged bet on AI demand continuing to grow fast for years. That's why I think CoreWeave belongs in a completely different category than companies like Oracle. Oracle can survive slower growth. CoreWeave cannot. But that's also where the upside comes from. If AI compute demand stays tight, if GPUs remain scarce, and if CoreWeave continues to win large customers, the operating leverage here is enormous. In that scenario, losses can turn into profits quickly and valuations can change very fast. So when I look at CoreWeave, I don't see a safe investment. I see a high-risk, high-reward exposure to the AI infrastructure layer. It's the kind of company that could perform extremely well in a strong AI cycle, and extremely poorly if expectations reset. And that's exactly why it matters in the AI bubble discussion. Because if there is a bubble, companies like CoreWeave will feel it the most. And if there isn't, or if AI growth stays strong, these are the kinds of names that can surprise people on the upside. The key is understanding what kind of risk you're taking. CoreWeave isn't about stability. It's about conviction. Let's quickly look at the charts, just to support what we've already talked about, not to predict short-term price moves. First, let's start with Oracle on the weekly chart. Oracle has behaved like a relatively safe, steady stock for a long time. It's been in a clear long-term uptrend, which already tells us that investors generally trust this company. If we focus on this year, we can see that from around April to September, Oracle made a strong upward move. After that, the stock started pulling back. This pullback makes sense. There's a lot of uncertainty around AI right now, valuations cooled off, and sellers stepped in. What's important is that this doesn't look like panic selling. It looks more like a normal correction inside a bigger trend. Keeping it simple, sellers are in control short term, but price is now approaching an important support area. One level I'm watching closely is around 166, which lines up with a key Fibonacci retracement level. If price reacts there, that could be a reasonable place to start scaling in, not all at once, just gradually. The next major support I'm watching is around 124. If price were to get there, that's where I'd feel much more comfortable being fully positioned, because at that point we could be forming a double bottom on the weekly chart. So for Oracle, the chart supports the idea of a slower, more controlled move, not something explosive, but something stable. Now let's switch to CoreWeave, which is a very different story. CoreWeave is a recent IPO, and the first thing you notice on the chart is the volume. Volume has been extremely high, which tells you there's a lot of interest and a lot of speculation. After the IPO, the stock traded around $33, and then in just a few months it exploded higher, reaching around $183. That's a massive move in a very short time. When stocks move like that, especially after an IPO, they usually haven't had time to build a proper base. And that's exactly what we see here. Instead of consolidating, price just kept going higher, almost levitating. Now that enthusiasm is cooling off, the stock is correcting, which is normal and healthy. From a technical perspective, this is where it starts to get interesting. One area I'm watching is around the low 60s, which lines up with the first major area where price previously accelerated higher. That zone could act as support. Right now, price is already close to an important retracement level, which makes it reasonable to start watching for a base or a potential double bottom. But this is very important to say clearly. CoreWeave is much more speculative than Oracle. It's an IPO, it doesn't have a long price history, and it can easily make lower lows before stabilizing. This is not a buy and forget stock. This is a chart you watch closely. If it forms a base or a double bottom, that's a sign risk is improving. If it keeps making lower lows, you wait. So the way I think about these two charts is simple. Oracle looks like a stock correcting inside a long-term uptrend. CoreWeave looks like a high-risk stock trying to find its first real support after hype. So let's bring everything together. After looking at the hype, the valuations, the fundamentals, and the risk, I think it's fair to say this. There is probably an AI bubble in parts of the market, not in the technology itself, but in expectations, pricing, and how fast people think everything will play out. And if history is any guide, that means many AI-related stocks could still drop significantly. 50% or more is not unrealistic in a true reset. That sounds scary, but it's also how long-term opportunities are usually created. Because bubbles don't destroy real businesses. They mainly destroy weak ones. So if you want exposure to AI, the question isn't whether AI is real. The question is where you're willing to take risk and where you're not. From that perspective, two companies stand out to me right now: Oracle and CoreWeave. Not because they're perfect, but because they sit in very different, very important parts of the AI ecosystem, and both have already been hit hard on price. Oracle represents the lower risk side of AI. It's profitable, it has real customers, and it owns infrastructure that AI depends on. Even if growth slows, Oracle is likely still around, still earning money, still relevant. It doesn't need AI to explode overnight. It just needs AI workloads to keep growing steadily. CoreWeave, on the other hand, represents the high-risk, high-reward side. It's not profitable yet. It carries a lot of debt, and it's extremely sensitive to how strong AI demand stays. But it also sits right at the center of one of the biggest bottlenecks in AI, compute power. If AI demand remains strong and capacity stays tight, companies like CoreWeave can grow very quickly. If expectations fall, they can also suffer badly. That's the trade-off. What makes both of these names interesting right now is that a lot of bad news is already priced in. Both stocks have dropped significantly, and both have active products, customers, and future projects that could increase their value over time. That doesn't mean they can't go lower, and it doesn't mean they're guaranteed winners. But it does mean the risk-reward looks very different today than it did at the peak of AI hype. So if there is an AI bubble, my view is this. The bubble is more likely in speculation and expectations, not in the core infrastructure. And when bubbles deflate, money tends to flow away from stories, and toward companies that actually build and run the systems everyone depends on. That's why, if you're thinking long term and you want AI exposure, it may make more sense to focus less on who promises the biggest future and more on who is positioned to survive whatever comes next. And that's how I'm thinking about Oracle and CoreWeave right now. Just a quick disclaimer before we wrap up. Nothing in this video is financial advice. I'm sharing my personal views and research for educational purposes only. Markets are risky, especially in areas like AI, and prices can move sharply in either direction. Always do your own research and consider your own situation before making any investment decisions.